We've been doing so well in terms of what an agentic AI might say, fucking up. We haven't really done that. And we're not going to start now, are we? We've got this. So, and of course, Jane McInness, the Senior Associate at DLA Piper. Put your hands together. I'll stop swearing. You guys have a great time. Thank you.
Hi, everyone. I'm not sure if we should all be personally offended that half the room left at the end of the last session, but we'll move on anyway. Thank you for the introductions. As you've just been told, I'm Jane McInness. I'm a Senior Associate at law firm DLA Piper, and I'm so thrilled to be here today to moderate this panel with 4 exceptional leaders from the FinTech landscape. So in today's environment, data is just all around us, but having the data is often just half the challenge, and the next challenge is how to deal with it, how to put it together and create meaningful and ethical credit decisions. So to get started, I'm going to do another little bit of a welcome to our panelists and a bit more of a detailed introduction to them. So to start off with, I'll start with Jamie on the end. We've got Jamie Twiss. Jamie is the CEO of Carrington Labs, a startup that builds next-generation credit risk models for lenders, and he's also the CEO of Carrington Labs' parent company, Beforepay. Previously the Chief Data Officer at Westpac, Jamie is known for combining data science and AI to improve consumer lending, particularly through the use of open banking transaction data and behavioural analytics. Next along the line, we have James Goodwin. James is the Chief Growth Officer at ASX-listed Wiser, which focuses on helping Australians make smarter decisions with their money. With over 15 years' experience in advertising and marketing, James is responsible for delivering Wiser's purpose-led brand strategy and customer experience-first approach. Next along, we have Anna. Anna is the Deputy CEO and founding member of Lumi, a leading Australian SME FinTech lender. Impressively, she was named the Outstanding FinTech Leader of the Year in the 2025 FINI Awards. Well done, Anna. A true testament to her influence in shaping the future in lending in Australia. Next along, we have Leanne. Leanne is the co-founder and CEO of Nemo Industries, an end-to-end online lending platform that provides a subscription-based white label loan origination and management software. Leanne has a background in organisational psychology and lending transformation, with prior roles at NAB and various consulting firms. So welcome to all of our panellists. I'm going to leave some time at the end for questions. So if you have any questions, just hold on to them and we can deal with them at the end. Let's jump in. So I think to get started, I've given a little bit of background about what your organisations do. Maybe we can just get a little bit more about why it is you need to evaluate creditworthiness and why you're doing that. So I'll start with Jamie.
Our product is the evaluation of creditworthiness. So what we do as a business is we work with lenders around the world to take enormous stacks of data and turn them into really sharp views on the riskiness of an individual consumer or a small to medium business. And so if we didn't do that, we wouldn't have a product to sell. I think just coming to your opening point, I think our observation has been there are always going to be technical and privacy and policy and many other challenges with getting the data. But for many people, they view that as the end of the journey. Oh, thank goodness we have data, and data is the new oil, so we should be fine by now. But actually deriving insight from, especially as these data sets gets larger, is enormously challenging. And our secret sauce is not in the ability to get data in the door. It's the ability to actually do something creative, interesting, and insightful with it once it's there.
James?
At Wiser, we're a consumer fintech, and part of our purpose is around powering people's progress with money, and that sort of comes in 2 parts. One part is we help people with financial management. We provide credit scores. We have a range of services we offer them. But progress is also about access to capital and access to loans, and so we risk-based price our loans. We have consumer personal loans and car loans, and credit risk comes into that because we need to obviously make money when money goes out the door, ensure it comes back. which keeps our funders happy and warehousing. And from my role in growth, it's also ensuring about that we're able to serve as many of our customers as possible. So it's finding, the right balance between credit risk and customer outcomes and making sure that we're lending fairly, safely, and appropriately.
Thanks.
Yeah, thank you, Jane. So, as Jane mentioned, Lumi is an SME lender. So why is it important that we accurately assess credit? That's because it's our whole business, and obviously making sustainable lending decisions is really, really important. But I guess talking a little bit more about, sort of the SME lender's role in the landscape at the moment. Why is it important that we're able to use data to accurately assess SMEs? So you think about SME Australia, I think it's pretty well understood it's a relatively underbanked sector of the economy. And why is this important? So, from one of our customer surveys that we recently ran, I have a couple of stats. 33% of them said that they struggled to access capital that they needed for expansion. And that's for expansion. That's for, employing more people and delivering more products and services and innovating. And 62%, which to me is just it's a huge number, missed a growth opportunity because of either delayed or inaccessible access to capital. So we think there is a huge opportunity in the market. You think about banks. Banks are one of the biggest lenders to SMEs, but they have a very sort of binary approach to lending. You either fit their model or you don't, and unfortunately most SMEs won't fit that model. So for us, it's about how do we use all of the data available to us to try and get to yes more often and lend to more SMEs. And I think, linking it back to some of the challenges we face in Australia at the moment, productivity gains and so on, we believe that a lot of that can come out of SME Australia. Finding ways to give them capital, we think is very, very important. So that's why we do it.
Well done, Jane, on your introduction, by the way. That was an exceptional job. As we go down the line, Leanne from Nemo, we provide a white-labelled product. We're a SaaS business, B2B, and we service and power everything from origination through to core banking. And what that means is that we are not the lender, we do not hold the pen, but we do need to provide the software that enables a lender and therefore the customer or the borrower to have that digital experience to access funds. So we support and power 24 different product categories with the one platform, everything from the most complex of mortgages and reverse mortgages to business lending to asset finance. So we power the lot with the one platform. So what that means in terms of creditworthiness is that we have to develop the software and the robustness and the data rules, the sets, the ability for it to be configurable, to ingest a lender's credit policy, their credit rules, HEM tables, etc., for that digital experience to work smoothly, seamlessly, and to enable some really fantastic outcomes from the borrower perspective and the lender so that we can protect both of them. And that's where that creditworthiness piece is really critical to our software. So a bit like you were saying, without the credit auto decisioning feature and the ability to look at the risk management there, it's a really critical part of our business.
Thanks all. To start with, I think my first question is going to be around what is influencing the way that you do credit decisioning, and in particular, what regulations are impacting that. And Leanne, I'm going to start off with you, given that you are making these decisions on behalf of the lenders themselves, often the banks.
So in some ways, we provide the framework and the scaffold for the lender to make the decision. So we are bankers. Many of us in Nemo are bankers at heart. So we came from the problem from within. So we know what good looks like in terms of the frameworks and the guidelines to enable the lender to then make that decision. To your question though, Jane, around the governance and the regulatory body in which, landscape in which we work, it has a significant impact on the software that we develop because, and I think Kathy Lyle was saying last night, or Brian, if you think about the most regulated country in the world, it's Australia. If you think about the most regulated industry, it's financial services. I would add a third question, what's the most regulated sort of organisation? And APRA regulates the banks, and so our software has to adhere to that regulatory environment. So in some ways, the way that we build and how we build, and it may be for others, different for others on the panel, but we have to have a really strict North Star around a glass box, not a black box, and the explainability that sits behind it. So that's how the regulatory environment impacts on what we build and how.
That's really interesting. Thanks, Leanne. Jamie, I might throw the same question to you as well. Which regulations are, or not which regulations, but how regulations are impacting your decisions?
Yeah, so like Leanne said, we are playing an advisory role to the lenders. So ultimately, the lenders are making the decision and bearing that compliance burden. But in order not to be sort of obnoxious and stand on ceremony, obviously we want to understand what they need to comply with and put them in a position to do that. I think when it comes to credit decisioning, really probably the two, and we operate all over the world, so many different regulatory environments. When it comes to credit decisioning, I think there are really two consistent principles that appear in almost every regulatory environment in different setups. And the first one of those is fairness, and the second one, which is becoming increasingly relevant, is explainability. There are others such as privacy and so on, but those are the two that are the most relevant and important to consider. On fairness, this goes back, well, literally centuries, and I think the key thing here is as you move to a much richer, more data-driven way of making decisions, it's easy to not to lose understanding of the decisions that you are making and why those decisions are happening, and as a result have unfair loan outcomes. So we all know that redlining, looking at somebody's address and not lending to them has been long since illegal in almost every jurisdiction. But if you're building a giant machine learning model and just chucking all your data in, you may well accidentally redline. So being aware of that, and that links very closely to that second point about explainability. So a lot of folks say, oh, AI is going to change everything. A lot of folks say AI is going to change everything. And then when you get down to the detail, you say, well, okay, and when it comes to lending, I think it is a very transformative and disruptive source, but you can't just chuck a bunch of data in and user information and application into any kind of LLM or any neural network-based model and just see what comes out of the other side, because the answer is you have no idea. It's going to be a black box. It's going to be different every time. And so you have to really construct the way that you approach loan decisioning in the age of AI, I think, quite carefully.
Thanks, Jamie. And I guess following on from that talk around fairness and explainability, James Weiser has a really strong focus on ethical lending. Are you able to talk to us about how you ensure that ethos is included in your credit decisioning?
Yeah, absolutely. I think probably the distinction, so we lend to consumers, so with the individual versus a business, and so we have an obligation to that customer who we're lending to. Probably the context, talking about regulations, is, looking back 10, 15 years ago, credit decisioning was really largely mathematical models, use a lot of data, and when the regulations like RG 209 and the NCCP came in, all of a sudden you're starting to take a more qualitative approach to assessing a loan. So not only do you have to look at the risk model, but is this product right for this customer? Does it meet their needs? And so responsible lending is a huge part of being ethical and ensuring you're abiding by the regulations, and ensuring that your data then is also non-biased. And so practically what that means is, there's really easy ways to take out certain attributes from a data source. So you can take out age and gender, for instance. But I think where it gets a little bit trickier is when you have what you'd call grey attributes, which they might be postcode or occupation, which have correlations. It can have strong correlations to a high-performing customer, or it might have a negative correlation. So a young borrower could have a lower income, for instance, or your type of employment could relate to your type of gender. And so it's important to ensure that you get as many of those customers as possible. You continue to test the models and ensure that you are removing those sort of biases from your decisioning.
Thank you. My next question is for Anna and for Leanne. Lumi and Nemo both provide same-day lending solutions. And so obviously there's a need to make decisions really quickly there. So I'm interested to hear about how you're managing to do that, and also, keeping in mind all these other things we're talking about, ensuring fairness while also producing speed.
Yeah, absolutely. So Lumi, we are a business lender, so we don't have the same regulatory environment as a lot of consumer lenders. But that being said, when we think about risk management frameworks and the way we use our models, you know, it still has to be really robust. And yes, speed is absolutely how we will differentiate ourselves, as I said, you know, as well as trying to get to yes more often. But nothing that we do really comes to the detriment of the way that we manage ourselves from a risk management point of view. And the way we do that is basically through technology and data. So technology provides the infrastructure to you know, do all of the things that you would expect to see in, you know, whether it's a bank or these more traditional organisations. Technology is just enabling us to do it faster and better. Not just our technology, but you know, all the technologies that we work with as well. And then it really just comes down to data and the availability of data and the data we use. So you know, if I think about some of the new products that we've recently brought to market, they're basically instant decisioning. So how can we work with platforms to use the data that they have about their customers to, you know, on an anonymised basis, credit assess pre-approved customers, so that, you know, when an SME logs into the platform that, you know, they transact on, they're actually getting presented with an offer that they can click and literally have money deposited straight away. So that, you know, whilst, you know, probably to a traditional banker that sounds, you know, pretty crazy, but it's actually not, because we're using the data. We're probably using more data in our decision making than is often traditionally used in making credit decisions, and the models are just becoming so powerful because there's so much data feeding them that they're actually able to, on average now, be more accurate and also more consistent in their decisioning than if you have a team of human underwriters. And I think that's the opportunity as we continue to, you know, play in this space, you know, to actually, you know, if I sort of talk about what we're trying to do, which is get to yes more often, fund more businesses, we can use that, the available data and more data than would be traditionally used in an assessment to holistically understand a customer, to be able to present them with offers pretty much instantaneously when they need it, point of sale, and so on.
Yeah, thank you. Leanne?
I agree. It's how you use the data and how you architect around it. I was reminded as you were sharing that story of working at enterprise level a number of years ago, and we almost undigitalised things. We put up these big Kanban boards and we were trying to work to time to yes and move it from 8 weeks to 6 weeks. It was the North Star, believe it or not. And it was in some ways where Nemo originated from. We knew there had to be a better way to get to time to yes, and it's how you use the data. So for us, how we get to same day lending, and for very complex loans, so mortgages, reverse mortgages, we do it in a way around our orchestration layer is really important. So we partner with a lot of service providers. We've got over 55 different integrations, best in breed, digital services. But we have one data lake, so we treat the data in our data lake. We have responsibility around the workflows, the pre-built workflows that go with each of those integrations. It's a really critical part of enabling that seamless experience. And because of Build Once, Serve Many, we have features. Last year, I think we had 292 new features in 12 months. The year before, 250. They're available to all our lenders as a white label product. So we're able to build and innovate and still keep our eye on that time to yes and time to money in the bank, in fact. Coupled with that, because of the architecture and how we're well architected for financial services, the data is more dynamic. So we have 3 portals into perhaps, let's call it an origination, one application. Everyone sees that dynamic nature of that application and where it is in that journey, whether it's with the assessment part of the assessment layer or whether it's in settlement. It also means it alleviates things like back channeling, mismapping. We seek to own the whole problem, not just the convenient parts, and that's how we enable same-day lending.
Sorry, if I can just jump in on that as well. So Jane, your question was essentially how do you maintain fairness while you're provisioning and decisioning loans very quickly? And through our sister company, we write tens of thousands of loans every week, about 40,000, and they're all decisioned on a fully automated basis, and it takes sort of seconds to minutes. And I think we get that question around quite a lot, which is how do you actually fully automate a decision? And I think there's a misunderstanding at the heart of people believing that there's this trade-off between doing a loan quickly and deciding a loan quickly and deciding it well. And I think the reason for that is ultimately computers are fast and humans are slower. And so the reason loans aren't done very, very quickly indeed is usually because of the placement of humans in the process. And if you think about what computers make decisions on, they're always facts of some kind, numbers, you know, Booleans and so on, whereas humans can either use facts or they can go on the vibe. Those are the two things they have to work with. And so ultimately, if you're putting humans in your decision process, either it's because you haven't been able to actually express your process in code, which is understandable with complex loans. It's actually quite hard to kind of write down in code and then execute that process, and it's different kinds of data. And so that's understandable, but it's not a feature per se. It's not necessarily a good thing. It's just where your capabilities are up to and where the industry is at. Or there's this kind of, I think, kind of holdover sense that like, oh, we should just have someone take a look at that. But in fact, what you're doing when you put humans back into that decision loop or leave them there when they could come out is you're putting the ultimate black box back into your process. So now you've got, you know, Frank coming into work every day and just sort of looking at an application and say, I don't think so. And if Frank is using facts to do that, then you should have code doing it. And if Frank is not using facts to do it, then I guess the question is, what is Frank doing? And do you really want that? And is that actually driving you towards fairness? So I think there's kind of fundamental misunderstanding that somehow humans have this kind of edge when it comes to sort of some sort of kind of holistic way of thinking about and looking at loans that leads to better risk outcomes or better fairness outcomes or so on, when in fact what we're basically just doing is kind of building kind of inherent learned prejudices into our financial system.
I think just touching on that as well, so you said, you know, computers are fast, humans are slow. Not only are they slow, they're also really inconsistent. You know, Frank comes to work one day and thinks, you know, yes, this time. The problem is he comes to work tomorrow and thinks, no, this time. You know, like they're really inconsistent. So when you're trying to understand, you know, the profile of your customers, you actually have to factor in the inconsistency of the humans making decision. Once you take that out of the equation, you can really focus on, you know, the customer and, you know, how the same consistent decision each time, you know, how is that impacting the outcome to the customer. So I think, yeah, it's counterintuitive, and it's something that we have to explain a lot to, you know, investors and so on as we roll out more and more automation. Oh, that sounds scary. No. I think in a few years we're going to look back and think we let a human do this. Like that's actually the scary part.
I'm going to take a counter view to both of you. I think auto decisioning doesn't mean the loan gets approved. So an auto decision means it's the connection between credit decisioning and credit risk. You put all the inputs in, computer says yes or no, and for us, yeah, 80% of our loans are auto decisioned. But telling a customer, hey, I know what you're trying to do. You're trying to, you know, put a renovation in your house. You're trying to buy a second home, a second car to take your kids to school or whatever it might be. And you tell them no, and they want to know why. That 20%, sometimes you need to look at those a bit closer because people's financial lives are complex, and not every computer can count for every individual. And so I think while there can be, you know, some inconsistencies that come in, but there's also the ways that you have your processes that go around that. You have your credit policy that can help adjust that. So I think fairness is also giving people the opportunity to get the loan, even if your computer says no.
I'm going to go in the middle. There's always someone that does the middle ground here. I think you're both right. I think you're all right. I'm thinking like exception-based decisioning is really where we're probably at, and that's certainly what we've baked into Nemo. There is auto decisioning for vanilla loans, if you call it, and they can straight through processing, but there are times where a loan needs to be looked at more critically. But we've got the guardrails because it's digitised for that assessor to be really clear on the guardrails, full transparency around any overrides and decisions that are made. If Frank decides to say yes one day or no the next day, but the level of transparency and the risk management on those decisions, the benchmark's higher and it's recorded and you still have the explainability there.
Yeah, and I would say even further to that, because I absolutely agree, and you know, it's actually important to know right now what can't your models do well and when does a human need to step in. And typically what we find is those points in time, as a deal is more complicated or more nuanced, the reason a computer can't do it yet is because it hasn't got enough data. So as you do more and more of those, the exceptions become less and less because suddenly it looks like something you've already done. And then once again, the data and the models, the machines can start to make better decisions. But it's all about having the data and having enough data that you can make those decisions. And so you're getting less and less of that exception-based lending.
We're now going to move to the trial by combat portion of the panel.
It's a good segue into AI, I think.
I think the future, though, of credit decisioning and creditworthiness, though, will shift because access to data will change. We'll be looking at social media profiles and a whole host of things. So, is too much data a thing? Maybe. It's actually what you do with it that matters and how you orchestrate that.
Yes, so James mentioned AI then. I think that it wouldn't be a conference in 2025 without a question about AI, so here it is. I'll start with Anna on this one. So maybe you can just probably each talk a little bit about how AI is impacting how you're running things. You've talked a bit about automation and not necessarily mentioned the word AI, so I'm interested to hear about how much of that automation is AI or other types of automation.
Yeah, absolutely, and I'll be quick because I can see that ticking down here. So, AI is really important in what we do. We absolutely use AI, but I think it's really important to make a distinction about what you're using AI for. So we were doing automation long before, AI was the thing it is today, and that's through, simple machine learning models and the type of models that have been used for a very long time in this area. But what AI has done, it's provided a whole lot of tools that enable us to better understand data and create more data to feed into the models. And example of that, and where AI has been really important in our business, is its ability to take unstructured data, turn it into structured data that we can then input into the models. And that's things like, for example, bank statement classification. In and of itself, it's not super useful. Once you're able to classify it, and particularly SME lending, which is relatively complicated, using that classified to feed into the models, that has supercharged those models. So I think there's 1,000 examples of how we can use AI to augment what we're currently doing to make it better, more reliable and more predictive.
To follow on from that, completely agree that certainly when we're talking about APRA regulated industries, we still need to have the glass box. I don't think AI at any time soon in the next, I'd say 3 to 5 years, is going to replace credit decisioning in its fullness. AI, though, I think about it like a hierarchy. You've still got to have your explainability, and AI has a role to play in the surrounding parts of that to supercharge perhaps categorisation, validations, to validate different data sources, and actually helps with the risk management. And we've got a good use case in Nemo where where APIs are difficult in some cases or not available or super expensive for a lender. We're using AI to pull the data, extract it, read it, categorise, validate, and then pre-populate. And it certainly helps in the broker world where we're seeing brokers want to take a customer off the market as quickly as they can. So rather than waiting for it to be remapped to a lender, it can be pre-packaged and be sitting with a lender in minutes.
I will just quickly ask Jamie and James if they have anything to add. I'm very conscious I have told everyone there would be time for questions at the end, and there in fact is not time for questions at the end. Was there anything sort of burning you wanted to add on the AI piece?
Just very briefly, we don't decision loans to AI, and I don't think we ever will until there's a very different way of doing AI. What we do is we build very deterministic models using other techniques. We use AI all the time to help build those models, right? So you can use AI to make the machine, but the machine then has to be deterministic and explainable. So it's all about being very clear on where you are and aren't using it.
Yeah, one final thing. I think, credit decisioning is high stakes, and certainly we have to think about how we use AI. A practical example that we do at Wiser, if you take inconsistent frank, for example, I think LLMs are really great at taking vast quantities of data, qualitative data, in order to help train decisions, and so we've used that in order to standardise the way that assessors can follow up with questions, rather than having the difference of assessors, asking questions in different ways and inconsistently. So that's a way we've practically used it to help support our team.
That's great. Thanks to all the panellists today, and please join me in a round of applause.